This is a demonstration of problem 18.5, allocate transaction price, returns, and consignments. Jarvie Ewell is a distributor of landscaping equipment. Its products range from small power tools, power equipment for commercial mowers, mini trenchers, and front-end loaders. Most products are sold direct via its company catalog and internet site. However, given some of its specialty products, select farm implement stores carry Jarvie's products. Pricing and cost information on three of Jarvie's most popular products are as follows, and the problem gives us three items: the mini trencher, commercial mowers, and front-end loaders, and gives us their standalone retail selling prices and the cost for each one of these items. The instructions state to respond to the requirements related to the following independent revenue arrangements for Jarvie Ewell. On July 1st, 2020, Jarvie sells 40 mowers to Mills for $280,000. Mills signs a 12-month note at an annual interest rate of 10%. Jarvie allows Mills to return any mowers that it cannot use within 90 days and receive a full refund. Based on prior experience, Jarvie estimates that 5% of units sold to customers like Mills will be returned, using the most likely outcome approach. Jarvie's cost to recover the products will be immaterial, and the returned mowers are expected to be resold at a profit. Prepare the journal entry for Jarvie on July 1st, 2020. So Jarvie has signed a note with Mills. However, this is only a 12-month note, so we're not going to have to record the any present value on the note because it will be paid within the next year. However, we do need to recognize when we record the entry that 5% of the units sold are likely to be returned. So we'll need to calculate the refund liability and the estimated inventory returns for the 40 mowers. The retail price total for 40 mowers at $7,000 is $280,000. So we multiply that by 5% and we get $14,000 for the refund liability. So we take the total retail price, $280,000, we subtract the refund liability, and we're only going to record sales revenue for $266,000. We're also going to establish the amount of the estimated inventory returns by taking the total cost of the mowers, which is 40 times $6,100, $244,000, multiply that by 5%, and we get the estimated inventory returns of $12,200. We take the total cost of the mowers minus the estimated inventory returns of $12,200, and we get cost of goods sold of $231,800. So now we can record the entry for the sale of the mowers to Mills. We're going to debit notes receivable for $280,000. We're going to credit sales revenue for $266,000, and we're going to credit our refund liability for $14,000. We would debit cost of goods sold for $231,800, and we would debit estimated inventory returns for $12,200 and credit inventory for $244,000. Next, in the B portion, it states that on April 6, Jarvie sells 20 mini trenchers to a farm co-op in western Kentucky. Jarvie provides a 6% volume discount on the mini trenchers if the co-op has a 20% increase in purchases from Jarvie compared to the prior year. Given the slowdown in the farm economy, sales to the co-op have been flat, and it's highly uncertain that the benchmark will be met, and it asks us to prepare the journal entry for Jarvie on April 6, 2020. So even though it is possible that the co-op could receive the 6% volume discount if they have a 20% increase in purchases, at the time of this sale on April 6, it does not appear that that benchmark is going to be met, so we would not be required to record the revenue and cost of goods sold net of the volume discount. So we would record the entry for the sale of the mini trenchers to the co-op by debiting cash for the full amount, $120,000, and crediting sales revenue for the same amount. We would debit cost of goods sold for the entire normal cost of goods sold of $72,000, and we would credit inventory for the same amount. In Part C, it states that Jarvie sells 3 loaders to a local company at a total contract price of $105,000. The contract payment also includes a $1,200 maintenance plan for the loaders for 3 years. Jarvie signs the contract on June 1st, 2020 and receives a 20% down payment. The loaders are delivered on September 1st, 2020 and full payment is made to Jarvie. And the problem states to prepare the journal entries for Jarvie in 2020 related to this arrangement. So we notice first off that we have a total contract price of $105,000 for 3 loaders and a $1,200 maintenance plan. So that means that we're going to have to allocate the $105,000 contract price between the loaders and the maintenance plan. We have the standalone price for the loaders, which is 3 times $36,000, which was given in the problem, or $108,000. We also have a standalone price for the maintenance plan, $1,200. So the total standalone for both of the for all of it is $109,200, but we're selling the bundle for $105,000. So to determine the amount of the contract price allocated to the loaders and the maintenance plan, we take each of their individual standalone prices. For the loaders, $108,000 divided by the total standalone, $109,200, and multiply that by the total contract price, and we get $103,846 allocated to the loaders. And we take the maintenance plan standalone of $1,200 divided by the total $109,200 multiplied by the $105,000, and we get $1,154 allocated to the maintenance plan. The problem states that the local company had paid 20% or $21,000 at the time that the contract was signed, and they would pay the remaining $84,000 when the loaders are delivered. The problem also gives us the cost of the 3 loaders, which is $28,000 times 3, or $84,000. So we're going to record first the receipt of the down payment when the contract was signed on June 1st. So we would debit cash for $21,000 and debit accounts receivable for $84,000. We have not delivered anything or provided anything ourselves at this time, so both the sales revenue and the service revenue on the maintenance contract would both be unearned. But we would credit unearned sales revenue for $103,846, and we would credit unearned service revenue maintenance for $1,154. Then on September 1st, when we deliver the loaders, we would collect the remaining $84,000 in cash, and we would debit cash. We are now delivering the loaders, so we can record the sales revenue. So we would debit unearned sales revenue for $103,846, and we would credit accounts receivable for $84,000 and credit sales revenue for $103,846. And then we would record the cost of goods sold by debiting cost of goods sold for $84,000 and crediting inventory for $84,000. At the end of the year, we would need to recognize the portion of the maintenance contract since the time that the loaders were delivered on September 1st. The total maintenance plan had allocated $1,154. This is a 3-year plan. We need to know the amount that has expired for 4 months. So we would take the total price, $1,154, divided by the total of 36 months, and that gives us approximately $32 rounded for each of the months. We would multiply that by 4 months, and that gives us $128 of service revenue for the maintenance contract that we would need to record for 2020. So we would debit unearned service revenue maintenance for $128, and we would credit service revenue maintenance for the same amount. Part D states that on March 3rd, 2020, Jarvie ships 100 mowers to Grass Depot, a dealer in Honda, on consignment. By June 30th, 2020, Grass Depot has sold 35 of the consigned mowers at the listed price of $7,000 per unit. Grass Depot notifies Jarvie of the sales, retains a 10% commission, and remits the cash due Jarvie. And the problem states to prepare the journal entries for Jarvie and Grass Depot for the consignment arrangement. So first we're going to record the entries just for Jarvie, the consigner, for the consignment of the 100 mowers. On March 3rd, when Jarvie ships the 100 mowers to Grass Depot, they would need to remove the cost of the consigned mowers from finished goods and debit it to consigned inventory. So 100 mowers at the cost of $6,100 each would be a debit to consigned inventory for $610,000 and a credit to finished goods inventory mowers for the same amount. The problem then states that at June 30th, Grass Depot notifies Jarvie that they've sold 35 of the consigned mowers at $7,000 each, and they remit the cash minus their 10% commission. So on June 30th, Jarvie would receive cash of $220,500. The total sales price was $245,000. There's a 10% commission, so that's $24,500. So the net amount is $220,500. So we would debit cash for $220,500. We would debit consignment expense for $24,500, and we would record revenue from consignments of $245,000. We would also need to record the cost of goods sold for the 35 mowers. So 35 times 6,100 is $213,500. So we would debit cost of goods sold for that amount, and we would credit consigned inventory for the same amount. Next, we're going to record the entries for Grass Depot, which is the consignee. Grass Depot would have received the mowers on March 3rd or about that time, but they don't make an entry to record the receipt of the mowers. They probably have some way of keeping up with the mowers, but they're not purchasing the mowers, so there wouldn't be any debit to an inventory account. They merely keep the mowers on their at their location and attempt to sell them. The first entry that would be made is when they actually sell the mowers. So at some point from March 3rd through June 30th, they've sold 35 of these, and they sold them at the regular retail price of $7,000. So they would have received total cash of $245,000. They would record their commission revenue, which is 10% of that amount, or $24,500, and then they would record a payable to Jarvie of $220,500 net of the commission, and then they would remit the cash to Jarvie. So we would record the sale of the mowers by debiting cash for $245,000. We would credit the payable to the consignor of $220,500, and we would credit commission revenue for $24,500. And then on June 30th, we would remit the payable to Jarvie by debiting the payable to the consignor for $220,500 and crediting cash for the same amount. And that is the conclusion of the demonstration for problem 18.5b.